Is it possible to trade Forex without using stop losses while still managing your risk? Of course it is. I'll show you the best method that I've found to do it. Hey there, my name is Hugh Kimura, and my mission is to help people create more freedom in their lives through trading. So before we get into the details on this, I want to invite you to put down everything you think you know about Forex trading. This video will challenge you a little bit. It will introduce some concepts that might be new to you. And after this video is over, you can choose to not accept or accept those new ideas. But I just want to expose you to them because the key to success in trading is to become an independent thinker, because when you can think for yourself, you'll be able to spot opportunities that others aren't seeing because they're following the herd and they're following the rules that they think they should follow. But there might be other opportunities outside of what everybody else is looking at. So I want to help you do that in this video. So why would you not want to use stop losses? First of all, I believe stop losses are great. They're excellent for most traders and most trading systems. I believe that they're the best way to manage your risk. However, there are a couple instances where you might not want to use a stop loss and it could be beneficial to do so. So why might you not want to use a stop loss? Well, there are a couple of good reasons. First of all, there's a thing called rollover, if you're not familiar with that. It happens when the New York session closes and the spread usually jumps up quite a bit, and that can stop you out. And here's a quick illustration of how that works. All right, so I'm on the Owanda website, and you can see on the website how big the spread becomes during the rollover period. And the rollover period happens at the end of the New York session. So let's say that you have a trade on, and the current price is only about 5 pips away from your stop loss. And then rollover happens, and then it could stop you out because, as you can see here, on Sunday, it jumped up to 10 pips during the rollover. So if you're only 5 pips away and the spread jumped 10 pips to 10 pips, then you could get stopped out. And that's the primary reason why you might not want to use a stop loss, because if you use tight stops or you tend to put your stops near support and resistance levels, that little bump from the rollover can take out your stop loss. The second reason that you might not want to use stop losses is because you prefer a more fluid method of trading. So you can kind of scale in and out of positions, and you don't have to be tied down to that hard stop loss that gives you that loss automatically. You want to be able to kind of chip away at a loss, take a little gain here, chip away at a loss. And I'll show you how to do that in a little bit. All right, now let's get into the mechanics of this. What we're going to do to trade without a stop loss but still using good risk management is to use hedging. Now, before you get into the comments and start saying that, oh, hedging doesn't work and blah, 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 hear me out, because I don't know of anybody else who really talks about hedging in the way that I do. So this could be a new concept to you, and it could be something that improves your trading. And before you start talking about this can't be done in a US account, yes, it can. There are ways that you can get around the traditional hedging rules in US accounts, but still do it legally. And I've been doing this for years, so I'll show you how to do it also. All right, now let's head over to the charts and see how this is done in a practical situation. Okay, this is the part you've been waiting for. How to enter a trade, manage your risk, but not use a stop loss. So here we go. So if we're looking at the Euro US dollar chart, a current trade right now that comes to mind is to just go long, because it seems to be hitting a reasonably solid support level. So that's a potential place that you could go long. So we're going to zoom in a little bit more and take a look at that. Okay, so in order to execute this trade, I would first have to go long. So I'm going to have my demo account open so I can play around with these ideas. And I highly recommend you open a demo account, play around with things, try to break it, try to push things to the max, because it's just a demo account and it's just play money, and you can always reload it again. And you obviously don't want to be doing this in your live money account with real money on the line. So play around with the demo account. All right, so we're going to enter a trade, and I'm going to buy at the market, and let's buy 10,000 units, since this is a decent size account for nanolots. So this is going to be 10,000 nanolots. And if you're not familiar with what nanolots are, you can watch a video that's appearing in the upper right corner right now. Okay, so we're going to buy it, and that's great. And we only used $234 in margin, so we got plenty of margin available on this trade. All right, so once that trade is placed, the typical move is to put in a stop loss, right? So let's zoom out and take a look at where that stop loss might be. So in ordinary trading or ordinary stop loss trading, you might put the stop below these lows here, or you might choose to put it down here and avoid both of those support levels. So if price got down to here, then you know you're really wrong, because this is actually more like a zone. There's no hard and fast lines, right? There's a zone between this low and then this green line, and in that, anywhere in that zone, price could turn around and go back up. So just to be safe, you could probably put your stop loss there. However, if you don't want to use the stop loss, you don't want to get stopped out by the rollover, then what you can do is you can hedge this position with an equal amount on a sell position at that green line. So in order to do that in a US account, I would have to jump over to another sub account. So US rules state that you cannot have longs and shorts in the same account. However, you can open another sub account and you can use that account for your shorts. So that's what we're going to do here. We're going to hop over to that account, and then we're going to set a pending order. So let's do this. And then it's a sell, and I'm going to use a sell entry stop. And if you don't know the difference, a stop enters a trade when price goes through it. With a limit, you want price to bounce off of that level because you want to get it cheap, right? You want to limit your cost of that position. So that's what a limit is for. But with the stop, you want the price to go through. So that's what we're going to do here. So I'm going to set the entry price at the green line. So that's going to be 15855, right? 158, okay. And I'm going to set that to 10,000 nanolots so that I'm completely hedged on that long position. So I'm going to sell. And then when I go over to the orders, that's going to be placed in my orders, and it's currently 146 pips away. So that's perfect. At this point, you're probably thinking, oh, that makes no sense, because if price does get down there, then you're going to have this locked in loss, and no matter where price goes, you're always going to have that loss, and you would be correct. However, you need to think a little bit three-dimensionally. Having those two positions gives you the opportunity to make profit on both sides and roll off part of the losing side. So let's take an example. So the ideal scenario here would be that price maybe comes down to here, and then it bounces back up to maybe here, and you can take some profits, and that's a nice trade. However, what could also happen is price could just fall through this level and just keep going. Maybe it went down to here. And in most cases, that would be a bad scenario, right? If you didn't have a stop loss, because you would be losing, or you could potentially lose all of your account if price went way down. But since you put in this hedge, you're also making money as this comes down. So what you could do is you could take off the short position at a profit, and then you could roll off a part of the long position at a loss that's smaller than the profit that you made on the short. So the net of those two trades is going to be positive. In addition, you'll also reduce the size of the long trade. So once you close that position at a net profit, you can decide what you want to do with the smaller long position that you have here. Maybe you'll wait a little bit for price to come back up, and then you'll short again, and then price will come down again, and you can make some profit, and then you could pay for this losing trade at a net profit. So maybe your short will be profitable when it comes down to here. Then you can close that out at a profit, which will pay for this losing trade up here, which is a smaller loss, and then you'll again have a net profit. So that's how you could get out of that position. Another scenario that could happen is that price could come down here. It could open the sell trade, and then it could bounce back up. So both of the positions would be losing. So in that case, what you could do is you could open both a long and a short in the middle of those two trades. And then as price moves up, you take profit on the buy. And as price moves down, you take profit on the loss. And then you can slowly start to roll off the losing positions like I mentioned. Or another thing you could do is you could place a small take profit below this sell trade. So if price goes down, it executes the short trade, and then it hits your profit target maybe right there, then you would have a small win, but you would still be losing on the long trade, right? So you would, at that point, you would hedge again, and you could maybe have another small profit target, and that way you can make some small profits while you're waiting for price to go back up again, and you can take those profits and use that to lessen your buy trade and make that smaller, so that if price does continue to go down, you're making profit, and then you're rolling off a little bit of loss, a little bit of a loss, a little bit of loss. But when you take the profit and then you roll off the loss, it comes out to a net profit. So it's a bigger profit and a smaller loss, so you get a net profit. Okay, so that's how you can trade Forex without using a stop loss, but still using good risk management. Now I'd like to hear from you. Do you think this could work? Do you think this couldn't work? Do you do something similar? I'd love to hear about it. I try to respond to as many comments as possible, so leave a comment below. If you want to learn more about how to do Forex hedging, check out my upcoming Zen 8 Forex hedging course. I'm relaunching that, so you can learn all about how to do Forex hedging there. If you like this video, a thumbs up is always greatly appreciated. Hit the subscribe button and the bell to get notifications when I publish new videos like this. Thanks for watching, and check out the videos that are coming up next.